Two stocks I'm buying in August of 2026. Those are two stocks that I did buy this week. They're still trading near the prices I bought them at. Both of them are undervalued. The first one is a stock that I talked about a few times, but I did buy the stock again this week. The second one is a stock that a lot of you guys found interesting, but I never did a video on it. So I'm going to talk about it in a little bit more details in today's video. And the common theme amongst both of those stocks is they are what you would call boring companies. They're not really exciting companies. They don't get a lot of attention from retail investors. But funny enough, those are the stocks that tend to do the best over the long term. Like this is a post that went viral on X about KC General Stores. This is like an old school gas station with pizzas and soft drinks or whatever. And if you look at the stock, it's up like 8,000% with very little drawdowns, no AI, OpenAI, Anthropic, SpaceX or whatever. There's none of those things. It just keeps on compounding. It's bulletproof, recession-proof, inflation-proof, pretty amazing companies. And those stocks tend to have those things in common. Those are my favorite companies in general. Like last month, I told you guys about Royal Gold. I said I'm buying it under $190, mainly a gold royalty stock. And I did buy it under $190. It's up like 36% on the months. It's outperforming all the AI stocks. And no one talks about it. It's just not exciting enough. But those are the stocks that I really like the best. And I'm going to give you two of them in today's video. Now, the first one is GFL, which I talked about before, and I've been averaging in the stock, and I bought a little bit more this week. GFL still trading at $41. This is mainly, you could say, a waste management stock. They operate in the United States and in Canada. The business model is very recession-proof, bulletproof, war-proof, whatever it is. Garbage has to be picked up. AI can't disrupt garbage. None of that thing's gonna happen. So that business is gonna be here. If we have inflations that have pricing power, you can't really skip your garbage bill. You can't just let it sit on the street or let it sit in your own house. And those companies own over 90 plus landfills in the United States and Canada. You cannot rebuild those landfills. And this is what's giving this company a moat, mainly a physical moat, I would call it, regulatory moat. And those assets cannot be replicated. So it's a pretty amazing moat to have. Now, whenever people hear of such investments, they think of low revenue growth, value traps, and just low returns in general. But GFL isn't really like that. Like the company has grown revenues 17% CAGR over the last 5 years. Adjusted EBITDA grew at a 20% CAGR. Free cash flow grew at a 23% CAGR from 2020 to 2024. So that's not really you could say, a boring, low growth company. It's boring, it's recession proof, but it's also growing 20% in free cash flow, which is pretty amazing for me. Now, the company achieves this growth through two main ways. The first one is with organic growth. So they raise prices and they have volume. They grow about 6 to 7% in revenues on average, just from organic, so pricing power and increasing volumes in general. But they also complement the organic growth with mergers and acquisitions. And they acquire like 30 to 40 companies each year, little tiny businesses. They acquire them at an average multiple of 7 times free cash flow, or 7 times EBITDA, I should say, in the private markets. Now, in the public market, GFL trades about 11 times EBITDA. The majors like Waste Management, Waste Connection, they trade 13 to 15 times EBITDA. So imagine the value creation where the company is buying it at 7 times. Once the EBITDA is integrated in GFL, that's worth about 50 to 70% more because it's now in the public markets. So there's a lot of value creation over there. And that's how the company achieves massive growth. There's another fun point that I like to highlight with the stock is that they make a lot of, or I should say they generate a lot of CNG from a lot of those facilities. CNG is compressed natural gas, and there's something called a compressed natural gas truck where it actually runs on clean natural gas that's generated from the waste in a lot of those landfills. So now the company has converted about 25% of their trucks to compressed natural gas. They're going to convert about 45% by 2028. And if the company is making its own, you could say, natural gas and is putting it in the trucks, they can save a lot on fuel. So that's pretty amazing to me, and it's a fun point that I wanted to highlight with this investment. But in terms of the potential upside, it's really interesting. Again, the company is guiding adjusted free cash flow, including organic and mergers and acquisition, about low to mid 20%. So the company is guiding low to mid 20% free cash flow growth into 2028. And if we look at how much we're paying for this free cash flow, we're paying about 18.8 times free cash flow. So we're buying this recession-proof stock for less than 1 times price to free cash flow growth. It doesn't happen very often. And if the multiple remains at 18, 19 times, which I think is cheap, but if it just remains over there and they can achieve the 20% plus free cash flow growth, I would expect the stock to return about a 20% annual return, which again, I'm getting a combination of a recession-proof business, boring, it's going to be here forever, no AI drama or open AI and Anthropic and IPOs and all that. I don't have any of that drama, and I can get potentially a 20% annual return. So that really doesn't happen very often, and that's why I'm buying more of GFL. But there's also a near-term call option with the company because the stock got so cheap. A lot of private equity companies are looking to acquire GFL, and the CEO is not going to be selling under $50 a share. The current price of GFL is about $41. So you have about a $9 difference. It could be realized in the next few months, which is a pretty nice premium. But if the acquisition doesn't happen, you would get about a 20% annual return over the long term. If it does happen, it's about 25% from here in 3, 4, 5 months. So that's a nice call option to have, and they're still in discussion, so it could get acquired. But if it does, it gets acquired for 50, now it's at 41. But if it doesn't get acquired, the stock's still undervalued. So that's a pretty amazing setup for me, and that's why I've been buying GFL. Now, the second one that I talked about before, and I did buy the dip on the stock this week, is TPL, which is Texas Pacific Lands. I've been in and out of TPL many times, and I bought it last year. Then I trimmed a lot of my position at $520. It was up like 83% year to date by February. And then I've been adding back the stock around $340. I did a video on TPL with my interview with Varen, and I told you guys that I would put it as a wait with a buy under 340, and it got about to 340, and I did buy the dip on TPL. Now, TPL is, again, another boring stock that has outperformed the NASDAQ, the S&P 500, 29% annual return, and no one has heard of this company called TPL, or very few people did. But TPL stands for Texas Pacific Lands. They own about 1 million acres in Texas. They own a lot of acreage. Pretty amazing stuff. And, they have a lot of royalties that comes out of this land. So they don't actually drill the oil. You have companies like Exxon and Chevron and ConocoPhillips and all those companies. They go on TPL's land to drill the oil. Now, because TPL owns the land, they don't have to pay for the capex to extract the oil, but they do collect royalties for just owning the land. And this is why the company was able to increase revenues in general while the price of oil was declining. It's one of the few oil companies that can do that. And the reason why they could do that is because they have little to no capex and they collect royalties just for owning about 1 million acres, which is a pretty amazing business model. Now, aside from the oil royalties, they were able to create several other businesses over the long term. One of them is a SLAM business, which is mainly surface lease easements. So a lot of companies, they want to put in certain solar panels, certain pipelines. If you want to run anything on the land, you have to lease this space from TPL, and then they get leases and surface leases in general. But there's also a lot of water that's in the way of extracting a lot of the oil. And TPL was able to make a business out of it by putting some capex, in this case. They extract the oil, the water, I should say, and they sell it back to a lot of the producers, or they sell it back to other utility companies, or very recently, they want to sell it back to potential data centers that could be built on TPL. And this is the major call options with the company. Now, if you look at the revenue mix, now 52% comes from oil, 11% comes from SLAM revenue, which is mainly surface leases and easements. Water sales and produced waters, they make up about 37%. So the company is diversifying away from oil. And that's really good. And it will ultimately bring in more recurring cash flows for a company like TPL, which should lead to an elevated multiple. Now, if you look at the data center opportunity with TPL, it's absolutely huge because the sentiment on data centers is turning really negative in the United States. I mean, it's been going downhill. Even a lot of the Republican governors, such as Governor Abbott from Texas, he was considered one of the pro governors for data centers. Well, he himself, a Republican governor, he pretty much halted the development of 1,800 data center projects. And the reason for that is because a lot of people, again, they believe that, it could take away their water, take away a lot of their electricity, it could cause some noise. Some of it is true, although I believe it's a little bit over exaggerated in terms of a sentiment. They don't take as much water as people believe. And, in some cases, they can generate their own electricity. But the main reason for the halt is he wants to ensure that the data centers must not take waters needed by local communities. They must not take power needed by the Texas power grid. They must lower the cost of electricity, and they must not disrupt neighborhoods or rural communities. Where do you think is the ideal place to put a data center? If you don't want to take the water from communities, you don't want it at any local community, and you don't want it to take from the grid that could be used for a local community, you're going to have to put it out in the field somewhere a little bit far. And this is where Texas Pacific Lands comes in. It's a pretty amazing place to be building a data center because it's far away from a lot of cities. They have a lot of people living there. So there's not many people living in the Permian. It's an empty land. And you have a lot of empty land, you have a lot of cheap energy, and you have a lot of water. So you have everything you need to build a data center, which is why I believe this negative data center sentiment worldwide is going to bring in a lot of those projects to the Permian because you have an abundance of land, abundance of water, and abundance of cheap energy. This is everything you need to run a data center, and TPL is sitting in a very sweet spot that's not being appreciated enough. Now, the former CEO of Google, Eric Schmidt, he started a new company called Bolt, and Bolt mainly wants to build a lot of data centers. Their first data center will be built on TPL's land. And this could be a really big one. And it's not really the only one. There's a lot of companies talking with TPL to launch data center projects on their land to avoid a lot of the political backlash and to take advantage of cheap water and cheap energy and an abundance of land. And this is what the CEO said on latest call. He said, "I would be disappointed if I don't announce at least one or more major definitive agreements in the near term." There's a lot of interest to build data centers on TPL. It's not just from Bolt, but the Bolt deal could potentially be huge. And the estimate is that they're going to build about a 10 gigawatt data center campus in West Texas, and each gigawatt could generate about $125 million of water revenue for TPL. Now, the current revenue of TPL is about $1 billion. So if they generate $125 million from each gigawatt and they build a 10 gigawatt facility, this is an additional $1.2 billion of revenues. So this data center alone would double the revenues of TPL. And that's again an amazing opportunity for this company that has done well without data centers, with oil and with water and easements, and it has done well in all cycles. This cycle is not going away, but now they have data centers on top of it. So there's way too many call options with the company. And this is where the valuation discussion comes in, because the stock will always look overvalued on, you could say, metrics. You could look at the forward PE, but it's not really accurate because it's based on a price of oil that's changing all the time. And the stock will always look expensive. And every time I bought the stock, I bought it 3 times so far, and I made money riding a lot of pretty much the same wave with the stock. And I get a lot of questions on valuations, and the stock looks expensive. Well, it's expensive for a few reasons. One of them is because they have 65% free cash flow margin, little to no capex. They are sitting in a very sweet spot in terms of data center build out and other things. But I showed you guys that the Bolt data center alone could potentially double the revenues, not including other royalties increasing that have been increasing over time. And it's not including anything else. So when I look at the valuation, it's trading at 41 times forward earnings. It looks overvalued. But the way I personally look at TPL is I tend to try to buy it near its historical average in terms of multiples. And I treat it the same way I would treat gold or any unproductive asset. So I look at it like I'm buying land, I'm buying precious metals, but in this case, it's mainly land. And this is the land that keeps on giving. They keep finding new stuff. So I just want to own it as an asset and keep it a smaller percentage of the portfolio, normally between 4 to 6%, and I'm just going to keep it. But when I buy TPL, I'm not going to buy it at all-time high. I'm going to put the odds on my side, buy it when it's down 30, 40% from the highs, and buy it near its historical average on valuations, and I want to let them take care of the rest. So this is how I view the company. And I did buy the stock at $350 or $340, I think. And I want to hold it for the long term unless it goes up a lot, then I'm going to trim it again. And by the way, I share everything I do in real time, all my trades, option trades, everything I do, it's all in my group in real time. And this is the link if you're interested. But thank you very much for watching. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.